Good afternoon, everyone. This is Kim Schmidt. I'm the executive editor of Farm Equipment Magazine. Welcome to our latest webinar, Preparing for Tax Changes. Discover what's shaping up to impact equipment dealerships in conjunction with Pinion. Once again, we've got Mark Johnson from Pinion with us. Mark's the principal and lead advisor for Pinion's agriculture and construction equipment dealership segment. With that, we're ready to get started. Thanks again for joining us, and you can take it away, Mark.
I feel like this seminar we should have done on April 1st, so I could have said April Fools on some of this because, frankly, at this point in the year, we would have thought we were farther along in tax legislation than we wound up being. And so I added the word tariff to this because it wasn't there before. Before it was preparing for tax changes impacting dealerships. Added tariff because that seems to be the talk of the town lately. And we know a little bit more about it than we do on the tax side. So I'm kind of labeling this webinar as a pivot. I did one similar to this last year or last week at AED's CFO conference, and so some of the slides I borrowed from Daniel Fisher there at AED on the tariff side, because frankly he knows more about tariffs than I did. He handled the tariffs and I handled the taxes. So today I'm going to handle all of it for you and hope I get it right. Yeah, as we headed into this, when we scheduled these, I was really excited because, the last Trump administration delivered the biggest tax legislation in 30 years, back in 2018. And as a tax guy, we got to talk about all the good stuff that was going to come from that, as far as better deductions and lower taxes and all that kind of stuff that our dealerships love to hear about. And it just so happened that as we did that and we geared up for bonus depreciation at 100% and everything, then we headed into a period of time that tax law really just exacerbated our profits and made it even that much better during 21 to 23. And so, as some of those started expiring, we got to today, we thought that there'd be a whole lot more legislation to talk about. We do have stuff to talk about, but unfortunately, a lot of it's kind of rumorville right now, and we're not really sure exactly where it's going to be. So we labeled this session a pivot. So still, we hope to understand kind of what is pending, rumored, and possible tax legislation that might affect you, and then what are the opportunities and pitfalls for you. Most of those opportunities and pitfalls on the tariff side are going to be more related to your customer, where it's hopefully at some point the tax legislation will come out and affect both you and your customers. Definitely that the tariffs impact your OEMs a lot more than you, and we'll get into that a little bit. But along the way, we'll talk a little bit about where are there responses that you can do, and what are the best practices to line up for that. So where do we kind of stand on tariffs? This is an ever-ending or never-ending change. It seems like they're talk about rumors. Most of this stuff has been done with executive authority, and so it comes and it goes and it goes again, and then it gets put on hold and all that kind of stuff. So, but where are we right now? Canada and Mexico, we've 25% in tariffs on imported steel and aluminum, auto parts. Kind of 10% across the board tariffs on everything except for stuff that kind of was exempted in the USMCA stuff a while back, and that particularly is good for the ag side of our dealerships, because a lot of the USMCA, those provisions will not impact your equipment. On the construction side, unfortunately, that's not the case, and that's going to impact a lot of that. China, we've seen 145% tariff threats, and some of that's in place already, and some of it's to come. Some things have been put on hold for 90 days, but in general, we've seen, big tariff changes here, and some of you I know have already gotten some bills for some orders that you've got on a boat that's on the way here, and you're experiencing what that's going to look like. And so, first reaction is, the tariff is going to impact us. It's probably going to impact us sooner than we think, unless we get another 90-day extension at some point. A lot of you saw this in the news, and we had the whole formula for reciprocal tariffs, and frankly, some of this out there makes sense when you think of it outside of how it's going to impact you. When other countries are putting tariffs on us, they're much higher, then that seems like it makes sense for a president like this. But when you do that without fixing the other side first on the taxes, and you have taxes and tariffs then that can be kind of bad. But you know, you can see here there's been a lot of debate on how these numbers came up. Some people, you know, you can see most of them are kind of half, some of them are full, and some people think that maybe a little bit of artificial intelligence was involved in making these decisions. But they're real numbers. They're pretty big numbers, and you can see that the countries that have typically and historically tariffed us more, that's where the brunt of this is going. There's some weird countries in there that I'm not sure we buy or sell anything to, and they've also got some pretty high tariffs on it. The strangest part about these tariffs is the authorities that were used to craft them, and they were all under things that we've never really tariffed under before with Emergency Economic Powers Act and Trade Expansion Act. You can see that these rules have been, or these acts have been around a while, but presidents haven't typically used this to use tariffs, but they also haven't done a lot of tariffs in our past. So this is kind of a new thing for us to try to get through. But the fact that he used these acts to put those tariffs in place is going to obviously set up some legal battles, and those are already starting to play themselves out. Obviously, none of those have gotten to the place where we know what the legal answer is going to be, but we know there's challenges, which seems to be kind of typical of things that the Trump administration does as it gets challenged. Policy justification for them, like I said, there's things in here that we probably all agree with a little bit. Countries have been treating us unfairly, quote unquote. You know, we're looking for ways to raise revenue to pay for tax cuts, and I think Trump was quoted as saying, you know, if we can get other countries to pay our tax for us, so we could create the external revenue service instead of the internal revenue service. And while that sounds kind of fun, you know, that probably wouldn't work completely, but it's nice to think about. We have to address the trade deficits, and they've been growing, and you know, reshoring some of these American industries. It seems like every other presidential term anymore, companies come and companies go, and taxes go up and taxes go down. And they're kind of on this teeter-totter with each other on why or who's gone and when they went. And then certainly there's some national security and national emergency things that I think some of the acts that he used to authorize these tariffs were justified, you know, as far as food safety and security and things like that we've been worried about for a while. So we'll see how this plays out. You know, where we know what's out right now is we've got higher tariffs than we've ever had before. And this just kind of gives you a quick rundown from 1900 to now. You know, we used to be we used to have much higher tariffs. They kind of disappeared for the last 50, 60 years, and now they're back with a vengeance, and they're not just back kind of over time, and we kind of ease our way back into them. It was all at once here in 2025, and that's why it seems kind of so bad. You know, when you look at some of the people that have done analysis of what these tariffs are going to do to companies, there was an article that came out this morning that I was reading that it was PwC had estimated that the tariffs were going to cost American companies $989 billion, or nearly $1 trillion prior to the election. And prior to these tariffs going up, that number was about 76 billion a year. So it's a 13-fold increase that we all know if a company, or in our case, a manufacturer, is going to pay that much more in tariffs at some point, that manufacturer is going to pass the price along in the price of the equipment, and then we as distributors have to figure out how to sell it at those higher cash prices that, you know, is the price of the equipment plus the price of the tariff. Obviously, the equipment that's coming from China will take the brunt of this. And in general, goods coming from China are going to take the brunt of this. Of that 900 and some billion dollars, 650 billion of it is estimated to come off of Chinese goods. Mexico is about 64 billion, and Canada is about 60 billion. So that's why we keep talking about those three countries in particularly, is most of this number is coming from those three countries, and most of that from China. But, you know, as far as retaliation, there's been some talk. There's been some countries that have said, okay, we'll drop our tariff, and that worked exactly the way I think it was designed, kind of a threat out there to say, hey, we're going to raise your tariffs unless you do something about yours. And those countries, a lot of those countries did respond and have dropped their tariff rate. Two countries in particular seem to be fighting back a little bit about this, though, and that would be China and Canada. And right away they announced some retaliatory tariffs on that, and not only extra tariffs that have taken the number up higher in those cases, but also cutting back on some products they will even let be imported into their country. A lot of that is also going after some technical, like on the Meta platform and Google and things like that. That's affecting them, which will affect. You probably saw it this morning, or I think it was yesterday, that Amazon had threatened to start putting a price tag on Amazon of, hey, this was going to cost $1, and now this costs $1.47 or whatever the number is. And that was supposed to kind of get some political momentum for us to contact our congressman and say, hey, we don't like tariffs. Amazon since pulled back, and that seems to be kind of the what's going on. People make threats, people respond, and but China and Canada have done the most. Um, so the one thing we know, the only thing that isn't certain is we're going to go through a period of uncertainty in this. There's a little bit of a lull right now till July 9th. As these kind of reciprocal tariffs take place, then there are countries negotiating with the U.S. every day on trade deals. Will these remain? Will the Congress push back? Will the retaliatory measures happen? Don't know. What we do know is in the past, to pass trade negotiations like this with countries isn't something that happened in an afternoon or in a week kind of thing. And with all these tariffs in place, for these negotiations to be significantly done and in place by July 9th, historically, that would have been quite impossible. There's just too many countries out there. You saw the list a second ago. Too many negotiations, too many differences that are happening, and that would never even be something that we would consider to be something that could be done by July 9th. So with that in mind, a lot of these probably will go in place unless the administration pushes them back even farther. But to address a trade negotiations for every one of those countries would take the bulk of his term in office, and I don't think that's going to happen. Much like the tax bill that we're going to talk about here in a little bit. What we do know also is that Congress will, the midterms will be November of next year, which means they start running for those January of next year if they haven't already started running for those. And between the recesses that they have, that they're just coming up, they're on a little bit of one now, and then they'll be on one in August and things like that. There isn't a whole lot of time to get all this done before Congress winds up being distracted by their own reelection procedures that'll start next January. So what do you guys do? I get asked this a lot. In fact, there's been different organizations that have asked me to come on and say, hey, we need to craft what the equipment dealerships' response to the tariffs are, and frankly, there's not a whole lot we can do other than talk to our Congress people, write our Congress people, go to fly-ins and things like that, and make sure our voice is heard. But as far as once those tariffs happen, they're going to happen at the OEM level. So first and foremost, the response to this is going to come at your manufacturer's level, and whether or not they choose to pass all of that tariff along or part of that tariff along or kind of spread it out, what they're going to do, that is really what's going to impact us the most. Is what their decision is there will dictate what the price is that you get that equipment in on. So as I think about that, then what we'll have to be very careful about is our customer is going to remember what they paid for the equipment and then what the cash difference is to trade that in a couple of years from now. A couple of years from now, the fact that they paid a big tariff on something to get it, off of your showroom floor, that's not going to be a valuable part of that equipment anymore. That was a tariff that was part of 2025 stuff and may or may not have any impact on 2027. Who knows, by 2027, those tariffs might be gone. And so what do we do with that cash difference? The customer's certainly going to remember. They're going to remember, hey, I paid $150,000 for this. Surely I'm going to get my normal trade-in on that. But if a significant part of that is from the tariff, that's going to be difficult. That sounds complicated, but it's not really that much different than we've had during COVID we had big price increases because of the demand issues and because we're running out of supply. And, manufacturers are raising prices 23% or better a year for a couple years in a row. And now we're dealing with that now on the trade-ins. And so it's not something that you guys aren't used to. It's just something you might not think about because it's just a little bit different. This time it's a tax on there, not a price increase. So really then the main thing for you guys is just going to be, this is going to be a tighter and what I'll call a shifting margin. You might remember during those price increases from COVID, you had parts in your dealerships that were old priced parts. You're selling them at new priced parts. And so our parts margins, they went from 30 to 35, 37%, sometimes 40% during 22 and 23 as we were selling old stuff at new prices. And that's going to happen here too, only the opposite. We're going to have stuff in there that wasn't tariffed that do we mark it all up now for that tariff? Do we mark it up later? Do we only mark it up when we know we've paid a tariff on it? That's going to be for you guys to decide, but that is going to be, there's going to be a little bit of, you're either going to have a margin that decreases during there, or you're going to have a period of time where your prices might not look like your competitors' prices because you might have done something different with the old equip or the old parts that you got in there. And then the one that we're kind of worrying about right now for the next few months is, do we have any ability to cancel orders, particularly when they're on the boat on the way here still? Is there something it's probably too late to cancel them. Kind of probably depends on the manufacturer that you're getting them from, but certainly we need to be looking at, if we can push out some of this orders, if we don't need it right away, which I've seen most of your parking lots and your parts, we have a lot of equipment that we can sell right now without getting that in. And so if we can maybe push some of those orders back a little bit until this tariff thing, at least we know what it's going to look like. That's probably going to be the best idea. So that's what I got on tariffs. It's like I said, it's a little bit of a new world. It's definitely going to impact our construction guys. It'll eventually impact all of our ag guys. But even now, there are things there are parts that are not part of the USMCA that if you're getting ag equipment from China, if you're getting ag equipment from the Netherlands and things like that, those are going to be tariffed, and so we're just going to have to deal with that. As far as tax goes, there hasn't been a tax bill yet, and I'll talk about that here in a second, but that doesn't mean tax changes aren't coming. In 2018, like I said, that was the biggest tax act that ever passed, and in fact, it was so big that we had to, and then it was not only so big, but it passed by such a slim margin through a process we call reconciliation that they had to do things different. And if you guys kind of remember back from our grade school days on watching, what it takes to get a bill through, from Schoolhouse Rock, that doesn't work. That's not the way it works anymore. The bill doesn't necessarily go through the way it used to. Now the bill pretty much happens. Big ones like this particularly happen through a process called reconciliation, which just means House passes something, the Senate passes something, and then if those are similar enough and we take out the differences, we can get those passed with the slimmest of margin, 51%. But to do that through a reconciliation versus a bill, they have to make sure that it doesn't impact the deficit over a long period of time, and so they have to make concessions. So one of the only part of the tax bill in 2018 that was permanent was the C Corp tax rate went to 21%. If you're a C corporation, you might remember before 2018, it tiered just like an individual tax rate, that we paid some of our tax at 15%, we paid some of it at 25%, and some of it got as high as 34%. And then depending on if you were a really big company, maybe all of it was taxed at a flat rate, but it was in the 30s, not in the 20s. They wanted that tax rate to be permanent at 20%, but at the time, all the professional mathematicians that get involved in these bills said, we were over, so we were gonna impact the deficit, and so they sunsetted a bunch of stuff that we'll talk about in a second. And sunsetting them didn't quite pay for it, but taking the 20% up to 21% did work. So that's why we have a 21% permanent, so to speak, tax rate for C corporations. That's still in play because it's permanent, but permanent when it comes to things like this just means it's permanent until they change it. So that will have to be changed by law to get it to be different than the 21%. All this other stuff that we're talking about doesn't take a law. In fact, when they passed it, the professional mathematicians said we were over budget, so we got to sunset these. And so some of these sunsetted faster than others. Some of them changed along the way, but in general, most of these things are done at the end of this year. And so some of them are pretty big to us. These first three, particularly the first two, are the ones that when we talk about what should our lobbyists talk about, or what should we talk about if we get to talk to a congressman? These are the two things. The first one being the pass-through income deduction, or the Section 199A, as some people call it. And what this was about 50% of your C corps. The other 50% are pass-through entities, meaning you're a partnership or an S corporation. Well, when they took the C corporation rate down to 21%, and you guys were paying the tax individually for your company's profits, there wind up being an unfair advantage, and so to being a C corp. So rather than have everybody switch to C corps, which that's been known to happen, that's what accountants have done in the past. In response or in anticipation of tax bills, we start looking at reorganization structures and should we be a C corp, should we be a pass through, things like that. Well, we didn't want everybody to get switched to a C corporation. Government didn't anyway at that point. And so what they did instead was we had this 199A, which basically exempted the first 20% of your profits. And so it brought the effective rate of an individual paying on their business tax down to like 29.77%, which is bigger than 21, but a lot better than the 34 to 39 that you might have been paying otherwise as a sole proprietor or a partner, or as a partner in S corp. So that's why we did that. Now that goes away. So starting next year, if we don't pass something different, it will be a lot better to be a C corporation than anything else. And like I said, at least 50% of the people on this call are probably this something else, being a partnership or an S corporation. So we may see some reorganization structures happen if we don't see some significant progress made on a tax bill. The other thing that we all know about is that bonus depreciation number. This impacts both us and our customers. If you're a construction dealer, it impacts you probably even more than your customers, because the reason we got bonus depreciation, as a reminder, in 2018 was because we lost our like-kind exchange ability. So we had a big rental fleet, and we're always switching in and out the equipment on there. We used to be able to not pay the tax on the fact that we depreciated a piece of equipment, and then we swapped it out because we did the like-kind exchange on it. Well, that goes away for equipment and is only there for our real estate now. And so we didn't feel that because we had bonus depreciation, because we buy new equipment, we write it completely off. And so we were kind of told at the time, don't worry about like-kind exchange going away, bonus depreciation will be here forever. Well, then we got to the reconciliation part of that bill, and the way to make it work was they cut 20% of that a year after the first couple of years. So in fact, this year we're down to 40%. So you buy a $100,000 piece of equipment, you can write $40,000 of it off, and the other 60,000 we got to write off over time. And next year that number goes down to 20%. And so again, that impacts us a little bit from the equipment that we're buying for our own dealership, impacts our customers even more, especially our farm customers that buy a lot of equipment. Now, we do still have Section 179, and so that's one of the things that we like to complain about bonus depreciation being gone. But for those of you that are in farm dealerships, particularly, and you're trying to figure out how do I word this to my farmers, don't forget that Section 179 is still out there, which is basically the farmer's ability, or anybody's ability really, that buys less than about $2.5 million of equipment a year. They can write their equipment off at basically 100% that first year anyway. So the people that don't buy much equipment can still write it all off. The people that buy a lot of equipment, this is who that impacts. So those of you with big multi-unit discount type customers that are buying big fleets at a time, we might, if this doesn't get fixed, then we might have to kind of put them on a structure, which actually could help us, right? To kind of get them to a place where they're only buying a couple $1 million worth of equipment a year so they can still write it off. Another one that that impacts our customers probably more than it does us is this research and development credit. And essentially, that seemed like a really great thing. It is a really great thing when it works, that the customers that are spending a lot to to do different things to make their businesses do better in the future, make something better for their customers. They can get a credit for that research and development. But what changed here was that the expenses associated with that, we used to kind of be able to double dip the expenses we wrote off and then the credit we got. Well, they put this in place that the expenses related to that we had to capitalize and write over time. So it really kind of decreased the impact of the research and development credit for most of our customers. Now, the good news is that part goes away a little bit. So that's one of the good things that expires is that part that we have to capitalize that. And then the last thing that's that I've seen impact our dealers quite a bit last year was this business interest deduction limitation, and that was that started out a little bit different than it did. It used to say that your income couldn't be more than 30% of EBITDA. So we'd add back our depreciation and amortization. So we made $1 million, and then we had $1 million of depreciation. That was $2 million. So our interest could be a lot bigger piece of that. Now that depreciation has gone away, so it's really on EBIT, which is just your earnings before interest and taxes. And it caught a lot of our dealers in the last couple of years, and really limited those business interest deductions because business interest went up. Not only did interest percentages go up, but a lot of you ran out of pool funds and things like that trying to get equipment moving, and so you had significant interest expense that you didn't maybe get to take on your 23 and 24 tax returns. And so the good news is you didn't lose it; they're still sitting there as a carryover. And the good or bad news we haven't figured out is this business interest, the limitation technically goes away. What there's a little bit of controversy on is whether if you built a big carryover of this business interest deduction, once this limitation is gone, will you be able to take it? And every time the conversations get started with that, then you hear people say, "Well, they're gonna change this. They're gonna re-up the business interest deduction anyway." So I don't know where that stands. In general, it's probably a good thing that the business interest limitation is going to go away. I don't know what it means necessarily to your carryover right now. Then there's a lot of stuff that changed on the individual tax provisions. So this is going to impact you guys, whether you're owners or whether you're employees, and it'll definitely impact your customers as well on their cash flow at home, right? So individual tax rates, those will actually revert to old levels, which means that the tax rate will go up, particularly at the high end of the tax bracket. So that'll go. We'll be back to having that 39.6% tax rate that nobody liked at the time, and we were glad to get rid of it. That will be back, as well as some of the other brackets will also lift up. For the last several years, the standard deduction got really high, and personal exemptions went away. A lot of people didn't even realize that. They still gathered as a person that works in an office that people bring their taxes to also. We still got all the big shoebox full of stuff in a lot of cases that said, "Hey, here's all my donations, here's all my medical stuff, here's all my interest and taxes and things like that." And then it wound up, particularly because of the SALT deduction that we'll talk about in a little bit, and the fact that the standard deduction went up. Most of our clients really used the standard deduction for the last few years, and the personal exemption went away. And so this goes back to the old way. So starting again in 2026, that standard deduction for 2025 is about 30 grand for married filing joint filers. Next year that'll go back down to $16,600. Single, kind of same way, 15 down to 8,300. But we will get our exemptions back, so we'll get $5,300 per exemption on our tax return. So it's hard to say on individual customers what this will do to them, but in most cases this will be a tax increase, not a tax decrease there. Mortgage interest, this one's this basically as house prices have gone up. I know here in Kansas City, where I'm located at, it seems anymore $750,000 is kind of what a $300,000 house used to be. It's kind of that normal range, and so the last couple of years, mortgage interest has been limited to a $750,000 type issue. That will go back down to go back up to $1 million. That'll be helpful a little bit. Charitable donations, those will go back down to 50%. They had been at 60%. the last couple of years, so that we'll lose some charitable deductions. That'll hurt. Those charitable organizations that depend on that. The big one, and we're going to talk about this one a little bit more later, is the SALT deduction. What the SALT deduction is the state and local tax deduction. And what this put into place back in 2018 was a hard $10,000 limit. And that $10,000 limit was for all state taxes. So when I file my tax return, the most I could put on it was a $10,000 deduction that would, in the past, have covered anything I paid for property taxes, anything I paid for real estate taxes, anything I paid for state income taxes. And I got limited to $10,000. And for most of the clients that I look at, $10,000 barely covers their real estate and their personal property taxes in a lot of cases. And so essentially we got no deduction for state taxes. In most of our states, the last couple of years, the states fixed that a little bit by having the pass-through entity deduction that a lot of you have probably gone through the pain of putting in place. It wasn't the easiest thing to do. It took a while to get there. It took even longer to understand. And now we're going to have to decide whether or not we still use that, because starting next year, that SALT deduction cap won't apply. So in states like California and Minnesota, not to pick on them, but they have high state rates, right? And so where in Kansas my rate might be 4.9%, in California, it's over 10, and so that's a big deal that state tax deduction can't be fully taken, and so that will help some customers. But there's probably a lot of talk on what that SALT will happen, and we're going to talk about that a little bit more later. In general, itemized deductions will start to be more relevant, like I talked about, with the fact that we put the standard, if we get state taxes put back on there. And then the other thing that changes next year is for the last few years, the child tax credit has been at $2,000. That'll go back down to $1,000. There's also this one that if you didn't qualify for the 2,000, there was a chance you might get $500 per kid. That some people got. That one goes away. So in general, the child tax credit looks a lot less. And then the big one, as far as for our farm clients or for your farm customers, the estate tax provision was the one that scared everybody. That hopefully they all got their estate planning in order. If they haven't, they've got a few more months to get that done, because what happens at the end of 2025 is our exemption, before anybody had to pay estate tax on an estate, was $13.6 million a person. So for a married couple, that's the number you probably heard about, is $27 million, something like that. And so we were able to do some estate planning that moved farms, particularly to their heirs, before this happened, because what happens next year is that 13.6 goes down to technically $5 million, but adjusted for inflation. So we don't know exactly what the number will be yet, because inflation numbers aren't official yet, but it's going to be somewhere in that $7 million range if inflation stays kind of where it's at. So we'll go in half. So next year, if somebody dies this year with a $13 million estate, they pay no taxes. If they die next year with a $13 million estate, they pay 40% on that extra $6 million. So the same customer that pays no tax this year pays $2.5 million of estate tax next year. So it is a big deal, especially when farmland isn't cash. And so what's happened, the whole reason for estate planning during this time is that we didn't want to have families sell farms to pay their estate tax bill, and that's probably what will happen if we don't get some relief for this. So those things automatically happen. Congress doesn't have to get together and approve anything. They don't have to pass a bill. All they do is do nothing, and those things happen because they sunset. So what will Congress do? I mean, there's a little bit of talk of, are we gonna really ride off into the sunset and those things happen, or can we push the sunset down the road a little bit, or will we actually pass a new tax bill that kind of starts over and does something different? Well, both sides of Congress have passed something. So the House passed their budget resolution. Both of them passed something in April, right? But then the House Ways and Means Committee, which is the primary entity that starts the reconciliation process. They're on break right now. So they come back in May, later this month, and then hopefully they'll start working on that pretty quickly. Um, so Speaker Johnson in the House, he's expected to, he thinks that they'll start working on it, as soon as this week. Chairman Smith has deflected questions about when they're going to do that. But we're seeing a lot of articles and a lot of rumors coming out that there are some obstacles in place that they're going to be hard for Congress to get over to get everything that Donald Trump has promised us in his election. So if you kind of look at that, I thought I had invented a phrase here. What would Trump want? And I was thinking, man, I could make a lot of money off these bracelets. They'd be beautiful bracelets, probably, the likes of which we've never seen, right? But then I Googled it and somebody had already come up with a Trump bracelet there. They just didn't put the WWTW on it. So maybe I can still make some money on that. I don't know. But what would Trump want? So if we didn't have to worry about money and paying for it and permanency and sunsetting and all that kind of stuff, what we've heard from him is, I'd like to make what we did in 2018, or at least the good parts of that, to be permanent. So we'd want, all the stuff that we just saw sunsetted that helped us to not sunset. We want that to be permanent, to be back in place for 2026 and go in cases like bonus depreciation where it had gone from 100% down to 40%. We'd see that go back to 100% and stay at 100% forever. And we'd be as permanent as possible, which we all know what that means, be permanent until the next president comes from another party that wants to go back the other direction. Then it won't be permanent anymore because they'll create their own tax bill. But it would at least buy us 4 or 5 more years of that. In addition to that, though, Trump has floated some other things out there. He'd like to see that corporate tax rate go down to 20% for basically all companies and down to 15% for certain companies that make their products in the US. So to make it clear that, hey, if you're making your products in the US, we're going to have an even lower rate than if you're importing products from other countries to try to bring some of those factories back home. So we dropped the corporate tax rate. We've also got some interesting ones in there, like exempting overtime income, not only from Social Security tax, but from all income. So which is a strange one to me, just because that is definitely earned income. Never heard that one before, but it would definitely help our employees, and it cut down on what we paid in taxes on that overtime for our employees. It would also exempt tip income from income and Social Security taxes, which would help some of the restaurant workers and workers that get tips. Exempting Social Security benefits from taxes, man, that's one I'd love to see happen, just because I see too many of these people that their only source of income is Social Security and a little bit of interest and taxes, and yet they're still paying to file an income tax return because 85% or some version of their Social Security is taxable, and that's just they've already paid tax on that money at least once or twice, to pay on taxes on that again. Just that would be a nice one to see, but it costs to do all those things. And then there's been some talk about interest for the normal person that isn't in business. Interest on that they pay to buy a vehicle has never been deductible ever that I know about anyway. And I've been a tax guy for a while. But it's never been deductible. There's been some notion of floating out, if it's an American-made automobile, then the interest paid on that could be deductible. So that might spur some people to buy American more. So those are all good things if you think about it, but they all cost, right? In addition to that, on top of all the taxes that he wants, there's also some stuff that's going to cost, right? So he wants to cut government employment and waste. So that doesn't cost anything. That saves us some money, right? But it makes implementing all this stuff a little bit harder if we don't have people in place. And we'll talk about that with the USDA particularly in a second. We also have debt limits and ceilings we got to worry about. One of the strange ones, or one of the differences in Congress coming to the reconciliation, is the difference on what they'll allow for that number. And I think I've got that here on the next slide, but it's 4 million versus 1 million, or 4 trillion versus 1 trillion. How much will let that debt go up to have these tax savings in place? We also have a farm bill that needs to be passed, and the things that come with that. And in general, that's going to cost money, because that farm bill has gotten down to not much right now. When we look at the cash flow that farmers are getting right now, back 2 or 3 years ago, the number was 3 times higher than it is in 2025, because right now all we're really down to on the farm bill is disaster type payments. And then for our construction dealerships, we've been hoping to get a highway funds and transportation permanency for a long time. And so, again, that costs something. That could be some extra taxes. Who knows what all that is? But obviously, we know where Trump wants that. He wants it to be in low taxes and cut expenses and cut people and all that kind of stuff. So if we could get all this done at once, that would be great. There's just a lot of pushback to get that done. And in fact, I found this table that's out there that says how much each one of these costs. And so, for instance, you look at the exempting overtime from income from taxes, and you think, well, that sounds like a great idea, but it's going to cost somewhere between 500 billion and $3 trillion, depending on how you do the math on that of what the cost of that. So you add all the policies up, and the tax cuts and spending increases come to somewhere around $7 to $16 trillion. And so, if it's gonna cost that, then we can't do all that through reconciliation. We do have some savings that he's also proposed in there that eat up some of that, but in best case scenario, it's somewhere between 1.7 trillion and $15.5 trillion net of tax savings or decreased income to the government and expenses or increased net income to the government. And so either way, this is going to be fairly costly for that. And that's why we're talking about tariffs and taxes at the same time, because to the extent tariffs can cover some of this up, or to the extent that DOG finding savings in places can get some of this covered up, then we can get back closer to getting that worst case scenario or best case scenario number closer to zero, so we could have some more permanency. And politics aside, permanency is better, right? Because from our customer standpoint, the reason 2024 was wonky is because it was an election year, and so we always know an election year is going to be bad for our customers, because they're like, what's going to happen to my taxes? What's going to happen to interest rates? What's going to happen to this and that based on the election that's coming up? And so that always makes an election year wonky. Well, this isn't an election year anymore, and we're still wonky because we don't know what's going to happen, and frankly, all this talk about tariffs has confused everybody a little bit more than probably needed. Probably it'll wind up being not as impactful as everything has made it sound, but it's definitely got us kind of in a funky state of mind. So some of the reconciliation rumors that are out there, the biggest procedural question is whether or not how the professional mathematicians do their math, and is it on the current policy baseline, or is it on the provisions that are already on the books? And so depending on how you run that math, you can either say right now it costs what we just saw on the slide before, or it's not going to cost us anything because of where the economy is already at right now, and we can run our math a little bit different, and we can get that down underneath the number we want. So what the Senate did was they went out there and said, okay, we would actually be okay with if we add $1.5 trillion to the debt to pay for this. The House has said $4.5 trillion, and so the Congress has showed a little bit of saying, hey, we're willing to let the deficit and the debt get bigger right now, as long as if over a 10-year period we can show that because of the better tax rates and things like that, the economy will come back to life, more will go through, and the GDP will expand, and we'll bring in more taxes after that, which in historical perspective, that does usually happen. When you lower taxes, the government has collected more taxes. And so on a 10-year plan, they're saying, hey, it works. So that's the kind of stuff they're looking at. But there's also other stuff that's happening right now. That the tax writers, they're waiting for each committee to come out and say, what it is they want. The House Ag Committee, for instance, they say, hey, when we get to the Farm Bill, we're going to have to talk about Supplemental Nutrition Assistance Program, and that's a big number. So let's cut it. Well, then you have the states that don't want that cut say, well, we're not going to get on board with voting for reconciliation then. So there's a whole lot of politics that are going to happen, particularly on the Farm Bill, that's going to impact us, that we need to be out there talking about. And then we've also got some other rumors out there. You may have heard that they're proposing a 40% millionaire tax bracket, which is, I remember back to the George Bush days when he said, hey, read my lips, no new taxes. This would be a new tax, right? We've never heard of a millionaire tax bracket, and this would be a 40%. We already said we didn't like the 39.6. Granted, that's a rounding error to 40%, but this was one that people that made more than $1 million a year were going to pay a 40% tax rate. And while that sounds maybe fair if you don't make $1 million, those of us that look through to our customers know that if they're self-employed or if they're a big farm, $1 million when your company's income is coming through to your individual tax return, $1 million isn't that much these days. And so we'll see what that would do. As far as the SALT or the state and local tax deductions, there's been some talk about, okay, that comes back, but we got to figure out a way to limit it because we don't want the states to raise their taxes artificially so high that they get a deduction on it, and so the federal government essentially subsidizes. So all the other states essentially subsidize those states that have high tax rates, and that's what they don't want to have happen. So maybe we need to limit that. So some of those high state GOP or high tax state GOP members have said, well, $10,000 isn't enough. Maybe we'd be okay with 25 to 30. That'd cover most of our constituents, and that would be better. Others have proposed, well, hey, let's actually look at it from the other side. Leave it alone, and then maybe we limit how much companies can deduct on their state taxes because that's what the PTE tax did, right? So again, we talked about the pass-through entity tax. What we did was we shifted and said, hey, I'm a S corp person. I owe $5,000 on my share of the income to Kansas, and so instead, what we did was we had the company pay my $5,000 tax for me. They got a full deduction for it. I just got decreased revenue, so I essentially got a tax deduction for it. And so now what the proposal would be, well, let's limit what the company then could have taken, and we'll kind of deal with it that way. So either way, it feels like SALT is and sea salt, I think, is a great acronym, but SALT or sea salt is going to be on the agenda for sure because that's a hot topic right now. And then you remember Biden's. There was it was the Inflation Reduction Act. Very strange name for a act that did more to increase inflation than it did to reduce it. But regardless, there was parts of the Inflation Reduction Act that we all liked, right? Because there was some infrastructure spending and stuff like that. That a lot of that has already made its way through the economy or started making its way through the economy. So now that that's done, what a lot of the people would like to see is let's repeal some of the bad stuff in there. That there was, you might remember, there was a 15% corporate alternative minimum tax that was put on there, which would never affect most of you guys. That was, billion-dollar profitable type companies that had a 15% minimum tax on it. And then there's a 1% excise tax if certain shareholders sold their stock or sold their stock through that would maybe go away. And then on the expense side of that, modifying some of those carbon and hydrogen credit provisions that were out there and kind of take that expense back for the government. So those are some of the things that they're talking about in addition to tariffs and tax changes. But we also know, especially the ag dealers here, we're just as interested in making sure we get a farm bill, that biofuels gets extended, and what's going on at the USDA level. And so as far as all of this impacting that, the House Democrats, they've already warned Republicans, hey, if you put anything in there in that farm bill about reducing SNAP, we're not going to vote for reconciliation. And even those moderate GOP members have said the same thing. If the Republicans say, okay, well, let's pull the Inflation Reduction Act spending, and do that at the same time we're trying to extend the biofuel, then we're going to get some environmental controversies going on there, and we might not get the biofuels extended the way we need to, and that's definitely going to hurt corn prices and hurt states, those of you in high corn states. So that's something we're watching. There's been several proposals out there from Midwestern state Congress people that to extend a lot of the biofuel stuff, but we'll see where that goes because it all has to be looked at once. And then the other thing is the USDA, they're hoping to cut about 30% of their workforce, or 30,000 employees. And so, that's going to impact how all this flows through and how our farmers are already dealing with an economy that's stacked against them a little bit. And if we start, pulling some of the people that understand the farm economy, that work in the government, away from that could help, that could hurt us. One of the things that we've seen that scares us a little bit the most right now is there's talk out there of any loan that goes through the USDA that's in excess of $500,000. Not only does that have to get approved by the USDA, but DOG might be involved in approving loans of that size. And we know on farmland, $500,000 doesn't go that far. It sounds like a lot when you're talking about it, on in the newspaper or on television, but $500,000 when we start talking about $6 to $20,000 an acre land, $500,000 doesn't go very far. So all those things are kind of going to fight against each other and essentially lead for you guys into a 2025 possibly being as uncertain as 2024 was. I mentioned 2024 being wonky. I think 2025 is going to be just as wonky, at least until we get a little farther along on these tax negotiations. Now, what I've heard people say is kind of, though, worst case scenario. The politics are such right now that they do think worst case scenario we will get most of that 2018 Tax Act stuff extended again temporarily, for the next 3-4 years. Bonus depreciation is one, for instance, they've talked about, hey, we'll go to 100%, but only for 4 years. But 100% for 4 years is better than 20% or 0% for the next couple of years. So if worst case scenario is we kind of kick the can down the road, we hate that term, but it does work sometimes, right? And so that might be what happens. They are going to keep working though on towards getting something more permanent, or at least parts of this more permanent, so that we don't have so much uncertainty every year, at least in the farmers and our customers' minds. So, although my presentation might have sounded a little gloomy in there about our prospects for doing it, it does sound like if worst case scenario is that we do at least get some version of that back in place for the next couple of years, that will get our customers kind of back into the buying mode, hopefully, and reduce some of the uncertainty that's out there. So I put in a little plug here. We do have a service that you could certainly check into. Some of the information on my slides came from that today, but some of our customers have said, man, politics have gotten to be a real cost of goods sold for us, and we need to stay on top of it. We'd like to kind of get periodic impact or periodic updates on what is actually going on in Congress and what can we do about it. Brian Keel, our Director of Government and Federal Affairs, he does have a service through our firm that can help with that. And so if you're interested in that, I put his contact information on here. You can reach out to him, and that's a service that he offers, and maybe take some of that uncertainty out of it for you. So with that, Kim, I've got a few minutes left. If there's any questions, I'm a little intimidated by taking questions over some of this stuff, but who knows? It's not April 1st, but it's also none of it's in place yet. So I don't know that I can be wrong or right about any questions. So it would be more about, if there are some questions out there, I'd be glad to take them, but take under advisement that I might not know the exact answer right now.
Yep, definitely. We've got one that's come in, and then for anyone else out there, reminder, there's a Q&A icon at the bottom where you can submit your question. So the first one we have, in reference to the 2018 tax reform, which business and individual tax provisions are going to be the most difficult to renew?
Most difficult to renew? I would say the one that we want the most is the 199A and the bonus depreciation. I don't know that that's difficult to renew, because every time I've been to DC, for a fly-in over the last 4 years, both sides of the aisle have said they wanted it. So it's definitely an expensive one. But I don't know that it'll be difficult to renew, because there's momentum for that. So looking at it, I think really the difficult part will be the permanency part. I haven't really heard anybody attack any specific one of the things, because particularly once you get past the bonus depreciation and the 199A, the rest of them are kind of small potatoes. For most of us, just all those small potatoes add up, kind of thing. But that's probably more how I'd address the question. Is I'd really, those are the two that we really need to see fixed going forward.
Right. Any even remote guess on a timeline for some of this tax stuff to get passed?
Well, yeah, you kind of look at the congressional calendar. They get back next week. They take a break in late August, and then they're back late September for about a month before November, and then they take a break at Thanksgiving. So if they don't get if we don't at least make some significant headway, how this was worked in the past is we make significant headway between now and their August deadline, such that they've got a bill in mind that they're going to pass. They take their break in August. They go back to their constituents. They make sure that their constituents like it, and they come back right after that break and they vote for it. So hopefully, worst case scenario is that's what happens. Trump has said it's all going to be fixed by the end of June. And some have said by the end of May. I mean, a lot of stuff he said comes true, even though a lot of us say there's no way. So maybe that'll happen, but that'd be faster than we've ever seen Congress move on any of this. And not only are they dealing with an income tax side of this, but they're dealing with this tariff side of things, which means they're talking to all these other countries at the same time. They're trying to figure out our own income tax bill. So to have that done by the end of May or June, I just don't see happening. So hopefully July, first part of August, we might see that. But hopefully at least by June, we would begin these rumors and start to kind of circulate around. This is what we think is going to happen now. We at least have a crystal ball in mind now.
Mark's contact info was up on that last screen. Imagine you welcome questions.
I welcome questions. Yep.
If you don't remember it, you can reach out to us at Farm Equipment and we can pass it along as well. All right, nothing else has come through. So just a reminder again, we did record today's webinar. Everyone who registered will be notified when that recording is ready. And if you have any suggestions for future webinars, be sure to let us know. And we'll look into getting those covered. On behalf of Mark and the Pinion team and the Farm Equipment staff, thanks for joining us for today's webinar. Feel free to reach out with any ideas for future coverage, and a survey should pop up for you when you leave the webinar. Please let us know what you thought of today's event. Thank you, everyone, and have a good rest of your day.
Thanks.
Thanks, Mark.
Thank you.